Welcome to Persistent Quarterly and Yearly Update Call. Thank you very much for joining us. I'm sharing some items from the press release first, and then I'm going to request Sudhir Kulkarni to give an update. After that, I'm going to request CFO Sunil Sapre to share the financial details, and then I will give you a couple of highlights, and then we will take questions for the rest of the hour. So in terms of the revenue for the financial year, we did $470.55 million US, which was a 9.7% year-on-year growth. In rupee terms, revenue was 30,337 million rupees, a growth of 5.4%. The PAT for the year was 3,230 million rupees, which is 7.2% year-on-year growth. In terms of the quarterly numbers, the revenue for the quarter were $116.95 million, which was a decline of 4.6% quarter-on-quarter. In rupee terms, this was 7,525.46 million rupees, which was a decline of 5% Q-on-Q quarter. The PAT for the quarter was 737 million rupees, which was a Q-on-Q decline of 19.6%. I'd like to also mention that during the board meeting, the directors have recommended a final dividend of Indian rupees 3 per share on a face value of 10 rupees share. Just to remind you, in Jan 2008, the board had declared an interim dividend of rupees 7 per share. The final dividend, as per convention and law, will be recommended by the board as subject to the approval of the members during the annual general meeting. I'd like to share two management updates in the sense we have added two new board members. I'm really delighted that Professor D.B. Phatak, recipient of Padma Shri Award, who recently retired as Professor of Computer Science at IIT Bombay, has agreed to join our board. Mr. G. Eiferman, who is an expert in life sciences and healthcare, having held several important positions at Merck, who is based out of France, in Paris specifically, has joined as an additional director. Both of them are independent directors, joining as additional directors on the board with immediate effect, and they are, of course, subject to approval of the members in the next general meeting. I'm really delighted that we were able to get these two gentlemen who are joining the board, and we are also excited about having G. Eiferman on the board. This gives us a presence in Europe and also in the healthcare and life sciences area, where we are making significant investments as we look forward. Quick awards and other highlights. We organized a software edition of Smart India Hackathon, which was a big success. In this event, we had almost 120,000 students participate in the first round. And in the final round, which was held on 30th and 31st of March, we had more than 15,000 students who participated in 28 locations. Persistent was the main organizer of this event along with I4C, and it was one of the largest hackathons ever organized, and we are delighted at the success of the event. We are featured in the HFS Blueprint Report for Internet of Things Services for 2018. We set up a 276 kilowatt kWp rooftop solar plant in our Hinjawadi office. Next time you are here, we will be happy to show you the plant. And finally, we were featured in the Economic Times CSR Compendium for the work we have done as part of the Persistent Foundation. In the press release, we have shared a bunch of highlights and key wins. I don't want to go through them per se in this call, but I would like to encourage you to take a look at the two beautiful videos we have on our website, one from Mount Sinai Health System and the other one from USAA, which demonstrates some of the work we are doing with them. With this, let me... Okay. The other thing I would like to point out is that we are starting to see a lot of business that is all becoming businesses are becoming software-driven businesses, and increasingly every business is starting to look at digital as part of their business. So we have decided that it is better to have better flexibility in terms of not trying to separate out what is services and digital units, and accordingly we have decided to merge these units operationally for operational purposes and to avoid having to decide, since every business is coming out as digital, trying to separate that out. We have created a joint unit called Technology Services Unit. Atul Khadilkar is sort of the joint president with Sudhir Kulkarni. Sudhir will be responsible for sales and Atul will be responsible for delivery and operations for this combined and joint unit, which will have both of these together. We are still trying to figure out exactly what the best way to report would be, but we will be able to show performance of digital as well. So we think that digital is going to be a key part of our business going forward. Let me hand this to Sudhir Kulkarni right now, who can give you a view from the market, and then I'll let Sunil share a little bit about financial details of what we have presented this quarter.
Thank you, Anand. Good morning, good evening, wherever everyone is. I'm here in Boston. We had a fantastic conference here called the World Medical Innovation Forum, and I've been talking about healthcare focus. I'll touch upon that briefly a little later in the talk. For the digital business is what I'm going to talk about. It continued to add a number of new customers. Yet again, I think this quarter in Q4 we added 19 great new customers, 7 of which are marquee names, 2 of them large healthcare organizations and 2 of them large financial services companies. But despite this addition of these customers, there were 3 large digital projects sort of ended this quarter, and hence we ended the entire quarter with just about 6% quarter-on-quarter growth and about 43% year-on-year growth. I have been speaking about the next generation transformative digital platforms and solutions in healthcare and financial services that we've been building for U.S. customers. And Anand just referred to Mount Sinai and USAA that are featured in our press release. We were able to add significant wins with Neuro, the risk-based authentication solution that we have built in collaboration with USAA, and that was a highlight of this quarter. And we have generated significant interest within the healthcare community with our work with Partners Healthcare in building out a platform for transforming healthcare. The first application on this platform is already in user acceptance phase. This week, we were here at the World Medical Innovation Forum to present, where the major topic of discussion was the use of artificial intelligence and machine learning in healthcare innovation. I expect that our approach of co-creation with major institutions in healthcare and finance will yield the results starting later this year. The pipeline of business is strong, though the nature of business continues to be project-based rather than T&M deal structures, which are the traditional ones that we've had in the past, which presents the challenge of driving new lead generation and closing new business at a faster clip than traditional businesses. And you will hear a little more about how we have addressed this going forward for this fiscal year. We are doing something very interesting in this area. Park, our European acquisition from a few quarters ago, showed good growth this quarter and has also shown a very healthy pipeline build-out for business in ensuing quarters. With 2 new countries targeted to open in addition to Switzerland and Germany, as also new leadership strength added in Europe, I'm sure that we'll see a healthy growth in Europe as well. And APAC continues to show steady progress for us in the business. Let me talk briefly about the new technology services unit that Anand referred to, which combines the erstwhile services and digital businesses for us. Both Atul Khadilkar and I, who will run this unit together, look forward to leveraging the synergies of the respective sales and delivery teams towards improved pipeline building and operational efficiency. In conclusion, while Q4 was challenging for the reasons Anand mentioned and in the press release, I'm positive that the healthy pipeline, strong marketing and lead generation efforts being put in place bodes well for our business in the coming quarters. Back to Anand.
So I'm going to request Sunil to share a little bit of the financial highlights before I get back. Sunil.
Thank you, Anand, and good evening, everyone. As Anand and Sudhir have apprised you of the business developments, I will share with you more details on margins and other financial information as of 31st March. The overall performance for the quarter was impacted, as you know, by the degrowth in the IP-led revenue. The revenue for the quarter was $116.95 million, a decline of $5.58 million, 4.6% in terms of quarter-on-quarter decline, and 5% in rupee terms. The dip in IP-led revenue was 6.76 million in absolute terms, and in percentage terms it was 20.6% dip compared to the last quarter. On a year-on-year basis, the revenue for the quarter grew by 7.3% in dollar terms and 3.5% in rupee terms. On the full year basis, the revenue was $470.55 million, recording a growth of 9.7% in dollar terms and 5.4% in rupee terms. Going to the composition of revenue, the linear revenue grew by 1.3% quarter-on-quarter, driven by increase in billing rate of 2.8%, and the volume declined by 1.5%. The on-site linear revenue grew by 1.2%, mainly due to the growth in billing rate of 2.1%. However, the volume declined by 0.9%. Offshore linear revenue grew by 1.4% quarter-on-quarter, with the increase in billing rate by 3%, while the volume dipped by 1.6%. So for the year as a whole, linear revenue grew by 13.3%, driven by growth in volume by 7.2%, and increase in billing rate by 5.7%. The decline in IP-led revenue, as you know, directly impacts the bottom line, and the margin levels for the quarter were lower on quarter-on-quarter basis. The EBITDA margin came in at 14.8% this quarter as against 17.4% in the previous quarter, which is typically the fallout of the seasonally strong Q3 when we had significantly higher EBITDA margin, and the more than expected drop in IP-led revenue is the reason for the EBITDA margin dropping from 17.4 to 14.8. However, utilization for the quarter improved to 81.2% as against 79.9% in the previous quarter. As you would have observed, our headcount also declined, and that's the reason that some of the improvement in efficiency was derived to reduce the impact at the EBITDA margin level. On the depreciation and amortization front, it came in at 5.6% as against 5% in the previous quarter. In absolute terms, this was higher by rupees 28 million due to accelerated amortization of one of the old acquisitions. The higher percentage in terms of amortization is also attributable partly to the drop in revenue during the quarter. EBIT was 9.2% as against 12.4% in the preceding quarter. Coming to treasury income during the quarter, it remained more or less in the same line as in the previous quarter. However, we had a higher foreign exchange gain at rupees 150 million as against rupees 50 million in the previous quarter, mainly due to the rupee depreciation at the end of the quarter. PBT was rupees 984 million, margin of 13.1% as against 14.8% in the previous quarter. PAT for the quarter was rupees 737 million at 9.8% as against 11.6% in the previous quarter. For the full year, PAT was rupees 3231 million at 10.6% as against 10.5% in the previous year. The operational capex for the quarter was rupees 100 million. The cash on books is at 12,003 million as of 31st March as compared to 11,117 at the end of last quarter. The value of forward contracts we have outstanding at the end of this quarter is 103 million at an average forward rate of 66.95 to a dollar. Thank you all, and I hand it back to Anand.
Thanks, Sudhir, and thank you, Sunil. Clearly, this was a disappointing quarter in the fact that we are showing a quarter-on-quarter dip. And we were surprised towards the end at the dip that we saw, the extent of dip that we had on the alliance business that we had. We were hoping that we knew that we would have some dip because of the strong Q3 or year-end quarter, but the dip that we saw towards the end of March was higher than what we had expected. From the further analysis that we have done across the business, we believe that that was just a one-off blip. There's a bunch of things that got moved. Hopefully, we'll be able to get some of the revenues that we may have lost over the next 3 quarters as license revenues get signed up. But this was clearly a disappointment for the quarter. That said, we are continuing to be on this journey of transformation. As we add more and more percentage of IP and variability on that, we find that our ability to predict has a little bit of, it's much harder to predict an IP-based business than it is to predict a services-based business. So that's been a challenge and why we were not able to see the dip as early as we would have liked to see it. That said, as I said, this was a one-off thing, and we hope this financial year we should do better on all these other parameters. The business as such is looking quite upbeat, and we are quite optimistic about what we think the rest of the year looks like. Let me take a pause here and then open it out for questions and answer any of the questions that you all have. And, so let's open it for Q&A. I'll leave you then.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sandeep Agarwal from Edelweiss Securities. Please go ahead.
Hi, thanks, Anand, and thanks to the management team for taking my question. Anand, we see that, you clearly said that there is one-time blip or one rare incident which has happened because of which, the growth has fallen to negative territory this quarter. But, Anand, we started talking about digital far long back than anyone else spoke about it. But, in last few quarters, we have seen that many mid-cap companies who didn't have much presence in digital initially, they have also started, giving substantial proportion of revenue as digital, and also the growth numbers and the profit numbers are very, very significantly better, and they have improved a lot. But, we, in spite of being much ahead in that journey in terms of capability and forecasting the wave, we somehow had been hit by one or other thing every quarter, and we have not been able to, get the kind of delta which we should have got. If you see, even, companies of 20 billion size are posting 40% year-over-year growth on digital on a base of $4 billion, $5 billion revenue. And, what is happening? Where are we missing? What is the issue? And when can we see that supernormal growth which others are seeing?
Let me have Sudhir answer that question. As it is, he is the one who is running it. So Sudhir, why don't you take this?
Yeah, so I think there are 2 answers, or there are 2 parts to that question. So first of all is and I don't want to debate about definitions of what digital is and what digital isn't. So we started talking about what our digital business was based on an internal structure that we put together, and said we put together all our practices that we had, our partnership relationships that we had with some of the ISVs like Salesforce, Appian, Oracle, etc. And we called that out, and we said that part plus an initiative that we had, which was our own data platform initiative, we call that out as digital. The industry is defining things very differently, and if you look at that, there is no standard definition. So when people talk about 40% of their revenue is coming from digital, or this is what is growing, etc., I think it's all about the qualification of how people are defining it. And that's the reason why, going forward, putting together the technology solutions unit as one unit that also subsumes the digital work that we are doing, which kind of is pervading many of our services accounts as well. So if we were to sort of reclassify what work we've been doing in the services accounts, which could be classified as digital according to industry standards, our numbers would be very different as well. But having said that, that's the second part of that is, yes, I mean, there are certain, expectations that we had for growth from some of these partner relationships. They have not panned out the way we thought they would. We've had some individual-specific patch level, leadership-related issues. We've fixed those now. We are fixing more of those as we go forward. In the combined unit, we have much better strength and efficiency. And hopefully you will see a lot more results coming out of that, the digital piece of it. And we will try and parse this out, as Anand said, as to what our digital component is. But we see that increasingly customers are not really making a distinction between what is digital and what is, traditional kind of business. And therefore, this move will start showing some changes for you.
Sandeep, I think your point is well taken. I think we really need to show higher growth on a sustained basis on the digital part of the business. There is really no excuse. I must say that by and large the customers are buying these kinds of services. So our call has been definitely on track. I think our execution needs to improve significantly, no doubt about it. And we have made a few changes in the next, which you will start to see results on hopefully in the next quarter and the quarter after that. I don't want to start to make a whole bunch of promises on this call today because I think it would be premature to, make some of these statements. I have to deliver first. And on a down quarter, I don't want to make a random set of promises. So what you are saying is absolutely right. I think 40-45% growth that you're seeing in other businesses, we should see more than that. There is no reason why we should not do it. We have not executed as well as we should have is what I would say.
And Anand, sorry, but one more question I had was, which you can reply with clubbing other questions as well. But there is a sharp fall which we are seeing in client numbers as given in the PPT. Yeah. So in the IP late part, so some clarification there. And second, right. I would also like to just add a little bit on what. So they said that, okay, I agree that, classification of digital could be different, but overall growth numbers have improved significantly for mid-cap companies. You can see that. And we are not seeing. So let's discuss about only overall growth. That number has also not improved for several quarters now. So
you have a good point. And it's not about classification. Whatever the classification is, I think it's a question of relative growth on that classification. So it's not about classification. And whatever you classify, growth rate needs to be there for whatever is classified. So I don't think there's any excuse on that. I think we need to execute better. That's the real name on this one. But I think there were certain changes that we have made in the last 3 to 6 weeks, which will start to show effect. But I don't want to talk about it at this time to give you a projection or to give you something else. We'll show you better results next quarter, and then we can talk about that. Regarding the sharp decline on the clients, let me explain that, which also explains some of the dip on the Accelerate side. So we had a business which we had talked about a couple of years back called R Cloud, which was a migration product, and we had a one-off case that we had settled. In that context, we decided that business had become small and not viable, so we have shut that down. As part of that shutting down that business, we had a large number of very small accounts, so like few $1,000s per account, and there were a large number of those which we have transferred out. So that is the reason why the business gone down by about $500,000, but it included a large number of customers as part of that $500,000.
Okay, that's all. Thanks from my side.
Thank you. The next question is from the line of Ashiyanand from Allegro Capital. Please go ahead.
Yes, hi. Thanks for taking the question. The question is really on the alliance business. I'm just trying to get a better sense on the business. So we had the traditional IBM business and the Watson IoT partnership. So just trying to understand, what really is the split between both of these, or if you can share that. And are each of these pieces growing at different rates? And also thirdly, on the traditional IBM business, not the Watson IoT, is that really legacy kind of work, or is there any digital-related work on that piece? And therefore, the overall growth outlook over slightly longer term on this business?
Okay, let me take the last question first. The business that we have in the IBM Alliance business, which is quite substantial, is a mix of all kinds of things put together. So we do have quite a few businesses which are about new product development and building out new products which are related to the Watson integration of Watson technology into a whole bunch of applications. So good percentage of our business is around that. There is some business around data services and there is some business around security services as well. So it's a fairly diversified portfolio of various different kinds of things in the context of what we do for the alliance business. As part of that, we also have a substantial part of it which comes from IT, of which some of it we have called out as CE/CLM, but in addition to the CE/CLM product portfolio, we have other IPs as well which are part of this. And the reason I say the seasonality issue was that typically IBM, she said that, but in the alliance partner, they have a calendar year effect, and the last quarter of their calendar year actually is usually better. In the first quarter, they have had some odd changes and a bunch of other things. So some of the revenues that should have been collected as routine revenue got forward next, and we didn't find out till the end. And that's part of the reason why that number went down. From our further discussions with our customer, we feel that some of those should come through over the next 2-3 quarters again. But, unless it's there, it's not there. So that's the reality of stuff. But we do think that overall the business this year around the alliance business should grow. And there's one other point I'd like to make here is that we have added this year more sales people we have taken them from our partner, and we are working on adding more sales people in Europe. So we have added 10 more sales heads in the European market, which are selling the CE/CLM and other IBM products as part of the partnership that we have with them around reseller work. So we do expect that should generate higher revenues for us and give us better control over our destiny in some sense in some of the products that we have implemented.
Would it be possible to get some kind of a, sense of this percentage of the portfolio is actually digital type work and actually growing well, and this part is legacy and is actually declining? Is that the problem, or is the kind of problem that even the digital work is not doing? Just trying to understand a better sense on the color to also help us project going forward.
Okay. Problem in this one is, a little tricky because of various clauses that we have in terms of what I can share from this particular customer. So I will not be able to give you a very precise answer on this, but let me say the following, okay? Roughly, I'd say 40% of our business is IT-led out of the total. Yeah. And of the rest, I would say, at least a third of the business, a growing part of that business, is related to business that would have gotten classified as digital or non-legacy kind of stuff. So there is substantial amount of work that we are doing, which is of the new kind of work. And of course, there is, 40% of the business, which is with products that are, could be classified as legacy. So it's, I would say 40-20 is a mix of business there. But, these are very approximate numbers from my point of view, and I cannot give you far more detail than this at this time.
Okay, sure. No, that's very helpful. If I could just ask one last question. On the ISV part of the business, just trying to understand what's the digital opportunity there. The digital opportunity in enterprise clients is well understood. But is there, how's the outlook on digital opportunity in ISV specifically?
Actually, we are not classifying ISV digital as a separate thing in a sense that ISVs are product development work, and that has always been, whatever. Yeah, I don't know what digital in that really means. These are product companies, we build products for them. That's really what we do for them. I don't necessarily want to split hair into it to say which product development is digital and which product development is non-digital. I don't think it's really useful to track that. So our focus on digital is to say that people are starting to become software-driven businesses. We want to help people become software-driven businesses. And as part of that, when they're starting to implement next generation of technologies to do that, that's really what we are calling our digital story. And we are seeing most traction in healthcare and in the sort of financial services area. So that's really the high-level overview of what we are classifying as digital. But I think let's not go into the classification as the key thing. I think that's not that important. The fact is that part of the business has to grow, and we have to show growth on it. So that's really what it is all about.
Okay. Thanks a lot for the answers.
Thank you. We would request participants to limit their questions to one per participant. Time permitting, you may come back in a queue for a follow-up question. The next question is from the line of Nitin Jain from Credit Suisse. Please go ahead.
Yeah, thanks for taking my question. So my first question is on the overall business. So you had made a comment earlier that you expect FY19 growth to be better than the NASSCOM guidance. But do you think your growth can be better than what you did in FY18?
Absolutely. I think there is no real problem in the market. I think so there are two parts of what I would say where our numbers this year were lower than what we would have liked to see. Okay. So one has to do with the fact that in the last quarter we were expecting a better IP return than we got. And the second part is, of course, that I think we could have executed a lot better on many of the digital projects that we started out, but we could have been doing much more on that. Those are the two main reasons. I see no reason why we can't fix these problems, and we do expect that we can do better growth. But that said, I don't want to on this quarter number, I don't want to go around making any promises, but definitely we expect to do a better year this year than we have last year, and I'll be able to show you that number when we look at the first quarter's result.
Okay, sir. And the second question is around margins. So again, you had made a comment regarding aggressive investment on sales. So what does this really mean for margins? So does it mean that whatever levers you have on margins, you will just reinvest that excess margin into business, and there will be no expansion?
No, see, again, this quarter with the, miss on the IP side, that contributes directly to the margin. So we think that's a one-off thing. A few $1 million on the IP revenue would have made the margins look a lot better. We think that this year, whatever we should invest should be invested in sales rather than investing in product development. And other R&D work that we have done traditionally. We are reducing our investment focus from building new stuff at the moment to try to sell that, because, we think now we have enough to sell, and we think the market is ready to buy. So this year, whatever we have an opportunity to invest will be invested in sales rather than in engineering. And I don't think we will, on a yearly annual basis, we will go aggressive on reducing margins. We think we can maintain margins and even grow them. But it will happen gradually, and whatever investments we make will be made in sales. And ideally, these will happen incrementally. So, we would expect that these sales investments actually result in additional sales, which will pay for itself.
Right, sir. And related question on the...
Nitin, I'm sorry to interrupt, but may we request you to come back in queue for follow-up questions? Thank you. Sir, you may go ahead with your questions now.
Yeah. We take questions from Twitter first. So there were a couple of them. So one of the questions was about how many new logos we have added during this quarter. And the other one was about the reasons behind decline in Accelerite's revenue during this quarter.
So for the number of customers, I think the chart shows it. Can you show the number right now? The Accelerite decline has to do with the fact that we have closed down the R Cloud business and a couple of other, mainly R Cloud decline is really the reason why the Accelerite number looks like it has gone down this quarter. Total number of logos that we added were 48 for this quarter and 286 for the full year. That includes parts. These would be net new logos.
Yeah.
And potentially the number of customers have declined because of the R Cloud customer, the fact that we shut down that business, which had a large number of very small customers, meaning a couple of thousand to $500, $2,000, $2,000. So lots of customers and not the total share fairly small. Okay.
Thank you. The next question is from the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
So one of our larger peers was saying that when digital now touching the core, I think the larger players which have a full stack of services are gaining market shares. I think TCS was commenting like this. So considering that we are not present on the traditional services, whereas we are present on the digital stack front end, so are we missing out any opportunities because of the lack of traditional services? Thanks.
Well, it's hard to say that we are missing out on traditional because we don't have traditional services, but in the last year or so, I think we have opened up a large number of logos where we have digital activities going on, and I think we have enough to manage the growth that we need for the base that we are operating on. So I'm not constrained. I don't feel constrained on the availability or access to customers at the moment. That said, I'm not. I think digital is getting mainstream, so definitely those people who are working mainstream projects and customers will start to see more and more digital business. But also the fact that we have mentioned and started to say from the very beginning for the last couple of years, the fact that the effort for the same work is going down is actually true. And robotic automation and various other cloud-related technologies are pushing companies to do more with less number of people, and effort is going to go down for the same work. So both these trends are going to play along, side by side as we look at the next few years, as we look at business changes that might happen from effort-based businesses to businesses that are based on something else.
So just one more on the headcount, which has been coming down for last 5 quarters continuously. So whether that will constrain margin expansion next year, because already we have substantially trimmed the headcount this last 5 quarters.
No, I think one has to look at margins slightly differently. I think headcount reduction happened partly because we were carrying some extra headcount. I think now we are at a stage where as long as we are able to add headcount at the same proportion as the growth that we have, I think the margins would not be affected. But, I hope, let me say this way, I'm quite confident that this quarter the number on headcount will go up because we have reached a situation where our utilization numbers are above 80. We think, if you look at the numbers as well and you look at all the parameters that we have, all of them have trended well during the year and during the quarter. I think the miss that we had in VIP revenue this quarter has definitely hurt us. And, I'm going to not say too much more right now because I am on the back foot, but I do see a fairly promising trends are good. The market situation is all fine. I don't see a real problem. So I don't want to say more than that.
Thank you. In the interest of time, participants are requested to ask one question per participant. Time permitting, you may come back in the queue for a follow-up. The next question is from the line of Sunil Kothari from Unique Investment Consultancy. Please go ahead.
Thank you very much, sir. Sir, you mentioned in your opening remarks about increasing billing rates. So your comments on the demand situation and our capability. And second question is on IP-led revenue. We are $120 million. What type of growth should we expect? Double-digit growth is feasible this year? Some comments, please.
Okay, I'm going to sort of keep answers brief at the moment because we do have a long queue. But see, IP revenues growth will happen in 3 ways. One is the existing IP. We do have a few new IPs that we have brought into the system. If we are able to get the growth on that we are expecting on that should generate higher IP revenues. And we have some other partners through which we are selling. So there are multiple things that are going on in the system which would help in increasing the IP revenue. In addition to that, whatever we acquire during the year will also add to the IP revenue. So let's see on exactly what that looks like. And what were the other questions of it?
On billing rates, sorry. The increasing billing rates is what is showing better demand or what?
No, I think the market in the U.S. specifically, the availability of talent or availability of people in the U.S. is under pressure, clearly, for various reasons. So I think today if you have ability to deliver, you can charge premium. So I don't think billing rates are really a challenge for work that is being done, especially from the U.S. market.
Thank you. The next question is from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Hi, Anand, 2 questions. Firstly, if you could share some numbers around what is the total fiscal 18 number for the IBM IoT product-related revenues, and is it fair to say that there is no change to the full year plan with IBM on that on calendar 18, which you would have anticipated at the beginning of the year, despite miss on the 1Q numbers?
No, I think the IBM numbers for the quarter are roughly for the year, again, there's a little bit of FY versus our financial year versus calendar year, but roughly they're about $48 million on the IoT license revenues that we got. Okay, so that's roughly what it is. And it was, about $2 million less the previous year in between. Again, the problem is when you look at comparisons versus calendar year versus financial year, the first quarter plus minus can cause that 1 million plus or minus. So, roughly there's been a 5% growth on a calendar year basis from their point of view for us. And, we are trending higher than 48 now. So that's really where it is at the moment.
Sure. I'll ask one more question for Sudhir. If you could share what is the proportion of digital business which is still project related, and you were alluding to some changes you have made to make it more sustainable rather than just a project getting ended and then you have to refill it. So if you could allude to that, what exactly is the change you have brought about? Thank you.
Yeah, I think, as Anand mentioned, we'll let Q1 numbers really talk through what exactly we see as the impact of those changes. It's all internal in terms of how we are structuring our accounts and our deals. So we've decided to focus on a few strategic sort of relationships that we have got. We've added a lot of new logos in the digital business over the last couple of years, and we have seen some of them really are large marquee names in the industry, in healthcare and in financial services. So we have to focus on them. And somebody asked a question about how TCS has been, benefiting from some of the digital work happening in their incumbent accounts. And that's, I think, the story that we want to repeat here in those accounts that we have classified now as strategic accounts. So that's a big change that we are doing on the digital side instead of treating them as this project.
Thank you. The next question is from the line of Ganesh Shetty, individual investor. Please go ahead.
Hi, sir. It has been really a challenging quarter for Persistent. Sir, what changes we would like to define in our strategy, especially for IP-led business going forward, so that volatility in the business can be predictable for an extent, and we can really drive growth in the future? Can you please throw some light on this? Thank you very much.
So, unfortunately, it's a hard question for me to answer directly. I'll tell you what the problem is. So, we operate with partners on many of the IP revenue lines, and we get sort of an annual estimate in terms of what the approximate numbers are likely to be and what have been rolled out as targets by our partners. And then we find out really exactly what happens in the quarter just a few days before the quarter. Now, the partner we are working with is working on calendar year and not on financial year that is aligned to us. So we do have numbers for the year, for calendar year 19, which are not bad actually. They are reasonable. It's just that the Q1 numbers are bad, and that's what we find out just a week before it happens. Now, we try to check again and say, hey, you said these calendar numbers, are they still valid? And by and large, most of them still have been acknowledged as valid, right? So I'm sitting on a little bit of uncertainty on the Q1 number, but I have no real evidence to say that this is going to continue. That said, we also have other IPs that we are trying to sell where we have better control. We have added more sales people who are selling our IP, and if that starts to hit in, then we will have better predictability on our numbers. But today we are, substantial percentage of our IP revenue is coming through partners, and unfortunately we are going to be dependent on a sort of an indirect visibility to the numbers for IP revenues till the very end of the quarter.
Thank you. The next question is from the line of Josias Go from Saga Tree Capital. Please go ahead.
Hi, Anand. Thank you for taking my question. I just want to ask regarding this NASSCOM guidance that you gave out. Why are you so confident of meeting this guidance when you didn't even have visibility on this Q4 number that you guys were going to miss? Thank you.
Actually, I couldn't exactly follow the question, and if I'm not answering the right question, you can please ask again. But what I understand is that, you asked about the NASSCOM guidance and, what that means and how will our growth rate be as compared to the NASSCOM guidance. See, again, the NASSCOM guidance is single-digit numbers, and we think we can do a lot better than that and have, every evidence to believe that we'll make that. Beyond that, I don't know exactly. What I believe is that the Q4 number being lower actually makes it easier to make a NASSCOM guidance growth happen because this year becomes a little lower than what we were planning for Q1, because what we are planning for the financial year for next year has not changed at all.
I think what I wanted to ask is that, okay, so we've seen this, your IT revenues fall in Q4, but you guys didn't have much visibility you didn't know that this fall in revenues was coming, right? So how would you expect yourself to be so confident in beating the guidance? Maybe something like this can happen something like this in Q4 could happen again in the full year next year.
Yeah, of course it can happen, but the point here is, as I said to you, right, when we are working with partners on their estimates of what their year looks like and all the other numbers, we are dealing with them around calendar year, and calendar year has 4 quarters, and this is the first of the 4 quarters that we have. So that's basically what happened this quarter, and we'll watch in the next couple of quarters to see what that looks like. But, I have no reason to believe that we will not make, or the partners will not be able to make the numbers that they are expecting for this month, for this year.
Thank you. The next question is from the line of Pankaj Kapoor from JM Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity. I have 3 short questions. Anand, first on the IBM IoT business, you mentioned the full year growth was roughly about 5%. So even if we take this quarter out, which could have been a quarterly aberration, do you think the overall growth as well as the pipeline that you see for next calendar year, is it trending in line with what you had anticipated at the beginning of the partnership? I recall you were talking about a growth upward of 12 to 15% then. So just your thought on that. That's the first question.
Okay, on the IoT side, I think the license revenue parts, which are the IP part of the revenue, I think we are tracking to where they need to track. I think the gap has been mainly around professional services and other IoT business as such that generates the other parts of the revenue which have been missed right now. So the other side that we are trying to do, 2 different things which we'll get. We already starting to see results on that, and we'll start to see more of it this year. One is that we have become a reseller that allows us to get access to customers directly so that we can see some of the revenues directly to us. And we have added more salespeople who we have transferred from our partners so that we can be a business partner and sell aggressively in Europe. So if you look at next quarter's numbers, you will see that we have added more sales people in our team in Europe. So that will give us better control over the services business that we have missed in the past. But if you look at the 5 to 7% growth year on year that was anticipated, I think we are in the range that it was expected to be.
Sure. And Sudhir, you mentioned that there were significant wins for Neuro in the quarter. So is it something worth calling out in terms of the share of Neuro revenues or the size of the deals that you have cut? That is, if it is really significant enough for us to call that out separately. That's first. And second, my question to Sunil, are we going to follow a similar kind of wage cycle as last year? I guess it is sometime in the second quarter, or you want to prepone it? And if you have decided any quantums for that. Thank you.
So let me take the Neuro question. I think we are starting to see traction, but it's still early days to say what kind of price points we will be able to sell it at. It's been a range so far. And what kind of market traction, what kind of segment of market we should focus on. So these are still early days for this new piece of IP.
Sure. And Sunil, my question on the wage cycle here.
Yeah, the wage cycle, our wage hike kicks in on 1st of July, and this year we will maintain the cycle. We've not yet finalized any percentage as of now, still some time away.
Just one comment I'd like to make is that we do have about, 13 to 14 people on the queue. We have about 8 minutes. So I'm going to try to be rather brief and, try to move as fast as we can. Whatever we miss out, we'll give you answers on phone. So at least,
Sure, sir. Thank you. The next question is from the line of Ashish Chopra from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just a couple of quick ones. Anand, so firstly, in terms of the investments that you talked about into sales rather than on product development, should we expect the manifestation of those efforts reflect completely in the growth on the Accelerite side, or do you expect it to the sales efforts to also be into other segments? And the second one that I had was for Sunil. Sunil, the direct expenses this quarter were down by 20 crores. So just wanted to understand if there was any write-backs of any of these variable pay or bonus provisions, and to what extent that number would have been. Thanks.
So very quickly, no, I think the sales effort is going to be across the board, not just in Accelerite, and you will see numbers both in digital and the alliance business starting to, impact by the new additional sales. Sunil?
Yeah, on the direct costs, if you see, actually there is an headcount reduction itself, about 150 reduction in the headcount, which is one important reason. The second one being that we have an element of company performance bonus which is linked to the numbers that we make. And during the first 3 quarters, not knowing the blip in the IP revenues in the last quarter, we had provided for an amount which was not as per the CPB plan, the company performance bonus plan, and hence there was a write back for that particular amount.
Thank you. The next question is from the line of Dipesh Mehta from SBI Cap Securities. Please go ahead.
Yeah, just want to get sense about, Anand, about the progress which we made on the partnership which we announced a couple of quarters back on USA and healthcare partner. And in the same, if you can help us understand some of the IP which we are developing, Sentient, Share Insight, and all those IPs, where we are and what progress we have made over the last few quarters, if you can provide some details.
Well, it's a loaded question for 6 minutes to the end of the hour, but let me give you very quickly. So USA partnership is really what constitutes Neuro at the moment. So whatever we are talking about Neuro, and we have a lot on our website, and some testimonials is all USA work. The healthcare partnership that we have announced last year actually is doing quite well. We should have some real revenue-related activities in this financial year. In terms of the optimistic products that we see some action, I think Share Insights and Neuro, which are the 2 sort of ones that we have been investing, should give us some revenue. Sentient, we have some in trial. Depending on how that works out, we'll be able to tell you more. But yeah, there are a lot of, there is a lot of wood in the fire. Let's see how it cooks at the moment.
Thank you.
Let's take more an offline call, Dipesh, with you, because, you have more details that you would want, and I'm not sure I can answer now.
Thank you. The next question is from the line of Shivam Gupta from CWC. Please go ahead.
Yeah, just one quick question. That given the fact that you're entering the new year with the digital kind of coming through and Neuro and partners to contribute, would it be fair to assume that, we can have a shot at a growth rate which is fairly better than the 30% we did for this year? Thanks.
No, the answer is yes. The target for him is a lot higher than that. Now, if that doesn't happen, that will not be good for people on the project. That's all I can say.
Thank you. The next question is from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Good evening. Thank you for my question. Just one, I noticed that the number of the category which was greater than $3 million in clients, it's come down from 19 to 18. Can you elaborate on that? Any reason?
Yeah, so it's there's one customer that has moved on from that group to the previous group. They were probably on the border, and a little bit here and there. There's nothing spectacularly happening there actually.
Okay.
But if you look at year on year, the number is better. So last year we had 15 in that category, now we have 18. Okay. And this is sort of a moving target, and somebody will go to 2.9, will get missed out of this.
Thank you. The next question is from the line of Kumar Saumya from Wealth Managers India Private Limited. Please go ahead.
Hello, sir. Good evening. So my question is regarding parks. If you could share with me the revenue contribution coming in this quarter and for the year.
For the year, we did approximately $8.8 million coming in from parks, and during this quarter, it was about $3.75 million.
Thank you. The next question is from the line of Sangameshwar Iyer from Shubhkam Ventures. Please go ahead.
Yeah, sir, just a couple of clarifications. One, on the margin front, which we said that we would be able to maintain margins. Are we, since given that this was a one-off quarter, the margin profile that one should assume for FY19 as a base, would it be the 9-month average? That's what you're talking about here, or how should one look at the margins?
Clearly, if you ask me this question, I would not count this quarter in the list, right? Meaning, the 9 months is sort of what we would have expected. We should have gotten in this quarter, and that's really what I would like to suggest. But, I don't want to make a guidance at this moment.
Got it. Got it, sir. And so, one more follow-up. If we were to recoup, as you stated earlier, that the alliance business should recoup whatever we lost this particular quarter, of around 6.7 million. That should itself give us a steady of around 5-6% for the next financial year in terms of the alliance business growth. And if you were to look at the normalized growth that we used to do, a double-digit growth in the alliance business is something that can be achievable. Is there any headwind that we see to this, double-digit assumption that one can look at based on the recoupment and the normal business of the alliance?
So let me give you how you should look at this. Okay, you should look at, instead of looking at it in our calendar quarters, meaning FY quarters, look at calendar quarters. So look at calendar quarters for the four quarters during calendar 17. Compare that and compare growth on the calendar quarter. You do calendar to calendar comparison for what the growth ought to be rather than financial year to financial year quarter comparison. And that will give you a better sense. So, the fact that it was a 8 million minus between Q4 and Q1, or essentially ended at 6.8 million, I think it is not fair to say, okay, what Q2 will look like, because the partnership is not all uniform across the 4 quarters. I've been quite upfront about sharing the number to you. So if you pull out the numbers for the whole calendar year, it will give you a good comparison.
Thank you. The next question is from the line of Mayur Parkeria from Wealth Managers. Please go ahead.
Good evening, sir, and thank you for taking the questions. The product revenues the Accelerate revenues year on year have fallen from almost 70 crores to 47 crores. Is the entire dip driven by the fall in our cloud, or is there more to it in terms of, and how do you see that in terms of the FY19, the product, the Accelerate revenue? And secondly, sir, given that digital is taking all the shoulders of growth, against services, alliance and Accelerate, which are having muted growth or slower growth or, some hotspots. Are you happy with the quality of offerings in the digital and the way we are growing in the digital for the next 4-5 years?
Okay, so let me give you the last one first, because you're trying to find the exact numbers. See, I'm actually very happy with the quality of our business as we end the year as compared to the previous year. So in terms of the quality of customers, the quality of business we do with those customers, the amount of next generation business we have, all of those things. I think there are 2 problems that I'm not happy about this quarter, and as we close out the year, and those have come around in my conversation so far. One is the fact that the IP revenue, we were surprised this quarter, which we would have not liked to see. I think a few $1 million that would have helped us this quarter would have really shown the difference. And the second thing is that despite a 30% growth that we've had on the digital business, I think we could do a lot more than that. So those are the 2 main disappointments that I would say, and we have taken certain actions to hopefully help us fix both of those. So that's really where I'm going to stop here on what I can say about the next year. In terms of the Accelerate revenues, yes, so as you know, that many of these Accelerate revenues are also declining in the way they are designed, and some of that is naturally expected. We are sort of hoping and confident that some of the newer products such as Sentient, Share Insight, Neuro, and all these will fill the gap. But location business, which we were working on for the last few years, which was something we acquired from OpenWave, also we are closing out at the end of the year, and our cloud is the other one. But other than that, the three main areas that we are focusing on, one is relating to the cloud business, the second one is to do with security, and the third is around the data-related areas. We are at 7:01, so we are past 3 hours, so I'm going to request that, I'm sorry we have a few calls standard, but, I just want to be sensitive and respectful to people's time, and I'd like to end this call here. Thank you very much. But let me hand it back to Ali and let him close.
Sure, sir. Thank you. Any closing comments from the side of Dr. Anand Deshpande?
No, actually, I don't have any specific comments. Thanks a lot for, being here on this call. We are available and accessible, so I'm sure we'll take any calls that you might have. And, we'll be happy to answer these calls on email or answer specific questions that you might have. But we are past the hour, so I do want to stop here because...
Thank you. Ladies